Look at this chart. The price builds momentum, clears resistance, and looks like a guaranteed win. You buy in, but the very next second, the market collapses and takes your stop loss with it. These sudden reversals are deliberate. Large financial institutions engineer these moves because they need massive liquidity to fill their billion-dollar orders. They push the price up to trigger your buy orders, using them as counterparties to their own selling. To stop falling for this, we are going to build a strict 4-step mechanical checklist. This framework filters out the traps and aligns your entries with the institutional money. Before we start, open your trading platform. You need a clean candlestick chart, and you must activate 2 specific indicators, a volume panel at the bottom and the Relative Strength Index, or RSI. Trading on gut feeling leaves you vulnerable to these engineered traps. Following a rigid mechanical framework lets you spot the trap before it springs, keeping your capital safe. Step 1 is defining the market context. Zoom out from the current price action and identify the overarching direction of the market. You must establish a strict rule. Only take breakout trades that move in the exact same direction as a strong pre-existing trend. If the overall market is moving sideways in a tight range, stay out. Range-bound markets are the primary testing grounds for institutional fakeouts. Now move to step 2. Look at this chart. Draw a horizontal resistance line, connecting obvious equal highs, commonly known as a double top. This is our identified liquidity pool. Retail trading books teach people to put their buy-stop orders just above this line and their stop losses just below it. That clusters a massive amount of orders in one tight space. Institutional players can see this cluster. They intentionally push the price just past these equal highs to trigger all those pending orders, instantly absorbing the resulting flood of liquidity to fill their own positions. When you see an obvious resistance level break, treat it as a warning sign that a trap is actively being set, rather than a green light to buy. Step 3 brings us to the micro-analysis. The first absolute rule here is that you never enter a trade while the breakout candle is still forming. You must wait for the close. This comparison shows why. A fake breakout candle collapses before closing, leaving a massive upper wick that proves aggressive rejection. A genuine breakout candle closes with a thick, solid body above resistance. If the very next candle is completely red, the breakout failed. Abort. If the candle structure holds up, shift your focus downward to the second microanalysis check, the volume. This is a volume panel. For a breakout to be legitimate, the volume bar directly underneath that breakout candle must tower over the average of the last 10 to 20 periods. If the price breaks out but the volume bars stay flat and low, large financial players are not participating. The upward move is highly suspicious. A price jump without a corresponding volume spike is a mirage. It lacks the actual financial fuel required to maintain an upward trajectory. The final piece of step 3 checks the engine's health. We use the Relative Strength Index to measure the underlying momentum of the price movement. This graph illustrates negative divergence. As the price pushes to a new high, the RSI slopes downward to a lower high. The engine is dying. In a genuine breakout, both lines move in tandem. The RSI line climbs right alongside the price. Once all your microanalysis checks pass, you reach step 4, execution. Even with a perfect setup, do not let the fear of missing out force you to buy at the absolute top of the breakout. This diagram maps the safer approach. Watch the price pull back to test the newly broken resistance line as support. As that happens, look at your volume panel. The volume bars during this dip must shrink significantly, proving that aggressive sellers have left the market. Execute your buy order only when a clear, green, bullish candle forms directly on that retest line, and place your stop loss tight, just below that level. Waiting for the retest shrinks your stop loss distance and improves your risk-to-reward ratio. You secure an entry grounded in mathematical defense rather than emotional panic. Here is your completed framework. With these 4 steps, you have the tools to filter out market noise and trade alongside institutional order flow. But the most rigid mechanical system in the world falls apart the second human emotions take over the mouse. You need to track your own psychology just as closely as you track price action. Keep a trading journal and log exactly what you were feeling, whether it was the fear of missing out or sheer boredom, right when you evaluated step 3. To survive modern markets, you must pair the smart money framework with total emotional control.